Well, we're seeing plenty of action in markets at the moment, most notably around the gold trade. But certainly the week ahead brings plenty for traders to sink their teeth into. Of course, the back end of it essentially sees the Donald Trump Xi Jinping meeting and the possibility of 100% tariffs being placed on Chinese exports. Nonetheless, we have plenty on the economic calendar and the corporate calendar, with rate decisions and big tech earnings dominating in the week ahead. As ever, we'll look at the top tier items according to Trading Economics. It kicks off on Monday. Bearing in mind, in actual fact, there were so many top tier items, I had to trim some of them down. So if you look at your own calendar, you might spot a few more that I've cut out just to sort of fit it onto the screen, so to speak. So it kicks off on Monday. IFO business climate data out of Germany, the durable goods orders out of the US. Remember, as long as the shutdown's on, half the US data's not going to be released. I record this before the US inflation release on Friday, so some things might have changed by then, of course, but we'll be talking about sort of big picture perspectives nonetheless. If you're looking at Wednesday, that's when we start to see the central banks coming into play. We see the Bank of Canada interest rate decision with an expectation of a 25 basis point cut from the BOC. Then we see the rate decision from the Fed on Wednesday as well. The expectation is again another 25 basis points worth of cuts. Moving into Thursday, so overnight, Wednesday into Thursday, the market's expecting not much from the BOJ, and that's because, of course, we have a new Prime Minister coming into play. She's, of course, going to have new policies, and the BOJ need to really gauge exactly what their response will be and where their positioning is in the bigger picture, essentially. Then we've got GDP data coming out of the eurozone and from the US, inflation data out of Germany. Then we've got the ECB rate decision, no change expected there. Then Friday, manufacturing PMI out of China, inflation data out of the Eurozone, and the core PCE price index figure from the US, which again may or may not be released. So we'll kick off with the US. Now, like I said, it's a difficult one because ultimately we don't necessarily know if half the things we're talking about here are actually going to be released or not. The CPI is somewhat of a one-off. I don't necessarily think that the BLS are going to be releasing a huge amount of data other than that. Nonetheless, we're talking about a different body that releases the core PCE price index figure. So do we see an end to the shutdown or not? I mean, look, ultimately we don't know, but it wasn't so long ago that there was signals that from Kevin Hassett that the shutdown was going to end in the week, well, just gone pretty much. And, well, it still rumbles on. We don't necessarily see an end in sight. So durable goods, consumer confidence, trade balance, GDP, jobless claims, core PCE, personal spending, personal income, Chicago PMI, a huge amount of data. And it all sort of feeds into this narrative around whether the US economy is in trouble or not, and quite how much the Federal Reserve needs to act or not. Well, ultimately, the Federal Reserve is going to act because whilst we would have seen the inflation data between the recording of this video and the coming week and when the Federal Reserve actually announced this, I don't think there's much by way of chances that they're going to essentially be moved off course in terms of that 25 basis point cut that's currently being priced in by markets. The question mark probably is beyond that, right? So do we cut this time around? Most likely. Do we cut next time around, which is in December? Most likely. That's what markets are pricing. Beyond that, where do we stand? And certainly the data, if we see it, what data we do see, is viewed within that prism. How much does it force the hand of the Federal Reserve, given the fact that the outlook in terms of rates, if we look here, I'm sort of going back to front, the outlook in terms of rates from the Federal Reserve is that we do see the 2 rate cuts for this year, but then we don't really do much beyond that. Maybe not one more rate cut in 2026. Now, that stands in stark contrast to what markets are now pricing. As you can see here, markets pricing a rate cut this time around, 99% chance according to the CME. Then a rate cut in December, 95% chance. And then another rate cut in January, then hold for the next couple of months, next couple of meetings, and then kick off again in June with a rate cut every other meeting, basically. That's what markets are pricing. It flies in the face of the dot plot laid out in September by the Federal Reserve. So, who's right, who's wrong? Well, the Fed meeting should give us some ideas of that. So between the data that comes out, the CPI figure that comes out on Friday, anything that comes out next week as well, that, of course, provides the basis for those discussions around the Federal Reserve and whether they see the future as being very different now compared to how they did in September, or whether markets are getting a little bit carried away with themselves. Certainly, I think the back end of next year should be very different because, of course, it looks like we're going to have someone else at the helm at the Federal Reserve appointed by Donald Trump, and Donald Trump's primary motive is to get someone in that's going to be cutting rates. So I do expect things to ramp up at the back end of next year, the second half, because it's May that he's replaced. And that's why probably you see that pause in the middle here, followed by a rate cut in June. Another one in September. But really, it's all data dependent. We don't necessarily know what's going to happen. Are we going to see a surge in terms of inflation? I mean, ultimately, if the US actually do enact 100% tariffs, additional tariffs on China, that, of course, is a potential source of huge volatility for goods coming into the US. And all of a sudden, the outlook in terms of interest rate cuts really does take a significant change of direction. In terms of what the Federal Reserve is dealing with at the moment, of course, it's a dual mandate. They essentially want to keep a lid on unemployment. They want to keep a lid on inflation, or keep it around target. Inflation 2.9 for the core PCE price index, the Fed's favored metric. Unemployment, still low, in the fours. I mean, we've seen some movement towards the upside, but nothing too concerning. In actual fact, the concern has really come around some of the data coming originally from the ADP payrolls, now from the headline payrolls. You can see that here in terms of over the course of recent months. There are a significant amount of sectors where we're seeing negative job growth rather than the positive that you've seen in periods of strength. At the left-hand side of this chart. Now, also, you can see that much of it really is being propped up by one area, and that is the education and health services. So if you take that out, then all of a sudden things aren't necessarily looking great, quite frankly. So this is a very lopsided period when it comes to job growth. It's all really in one sector. That always has been, and you can see that on the left-hand side, a key area when it comes to job creation. But if you took it out, generally in the past, the jobs would still be growing. That's not necessarily the case at the moment, and certainly there's a number of sectors that are sort of contracting in terms of job creation. In terms of inflation, once again, we're looking here and saying, well, core PC price index, that's largely under control, and to an extent it is. But if you look at the sort of shorter term, so monthly metrics, it starts to tell a bit of a different story. I'm looking here at the headline CPI number, but you could do this for the core PCE price index as well. Ultimately, the monthly figures have started to pick up pace. And generally, if I've got the 3-month annualized, the 6-month annualized, and the year-on-year figure, what will turn first will be your 3-month annualized. In actual fact, you'll see it first in the month-on-month figures. But I like to utilize the 3-month annualized because ultimately you can always see major movements on one month to the next. You want to see a shift in terms of the trend. Well, what we've been seeing over recent years is this sort of oscillation that you're seeing on the sort of right-hand section of this chart. We don't necessarily see a breakout from that. And as you see on the left-hand side of this chart, generally once you see a breakout with the green line, that sort of points towards the direction that the 6-month annualized and ultimately the year-on-year figure that everyone talks about, the direction for that to move in. So at the moment, we are seeing an uptick in terms of short-term price pressures. Whether that's short-term in nature remains to be seen. But like I said, that CPI number that's going to come out between me recording this video and between next week, that should give us a good idea of where we go from here. But 0.4 is what markets are expecting. And if that comes out, then yeah, it's probably more of the same, right? That means we're probably going to move higher in terms of this green line. So in terms of where that sort of stacks things up, ultimately we've got a week ahead that has significant data coming out, but some of it might not come out. Well, we've got the Federal Reserve meeting where there's a differential between what markets are expecting and what the Fed has laid out in terms of their dot plot. So what's their outlook going forward? How do they see the first half of 2026 in particular? How do they see things given the lack or dearth of economic data right now? These are key factors for markets at the moment, because whilst there's huge confidence in terms of the rate cuts for this meeting, the rate cuts for next meeting, the confidence level around that January meeting is 55% chance of another rate cut. That's not high confidence. That's essentially a coin toss, and in which case markets are quite willing to move in one direction or another, depending on exactly how the data comes out. Now, let's look at the charts for this. So first and foremost, we're looking here at the dollar index. The dollar index is sort of struggling for direction at the moment. If you look on the weekly time frame, that collapse that we saw at the beginning of Donald Trump's second phase in the White House really appears to have stalled in quite a meaningful manner. There's question marks here about whether we're seeing a bottom, and that could potentially be the case. Now, bear in mind, between the inflation data coming out tomorrow, but coming out in this week, and then the FOMC meeting, it should give us a good idea of the directional bias for the US dollar over the near term. If they start to take on a relatively hawkish tone and say, we're not in a rush, we're data dependent, we don't necessarily know what's going to happen with inflation. For all we know, Donald Trump's going to enact 100% tariffs on China, and therefore we're very cautious. You could possibly see further upside coming into play here for the likes of the US dollar. Over the 4-hour chart, you can see that we're sort of trending within this pattern of higher highs, higher lows. The more recent pullback takes us into, into the sort of deep fib zone that you can see here below the 61.8. So at the moment, we're just continuing that rebound from that zone, trying to extend further towards the upside. Now, crucially, we're still stuck within this pattern of seeing lower highs, although at the bottom end, we do see largely flatlining lows. It's near enough the same, right? So towards the upside, really a key signal that we've bottomed out here would come if we see a break through that 100 mark. Essentially 100.257 is the line in the sand to watch out for. So at the moment, we're sort of regaining ground, but certainly greater confidence of a bottom here comes with a breakthrough 100.257. And between the inflation data and the FOMC meeting, that should inform us over the directional bias. In terms of gold prices, look, I had to bring up gold prices because ultimately, this has been the big mover, and it's also been the chart that everyone's been very keen to trade, or the market everyone's been keen to trade, and for good reason, right? We can just see week after week after week, it did more of the same. So that's great. We all love a chart that is very, very predictable, but the trend is your friend until, they say the bend at the end, but until suddenly the thing collapses, right? And that's exactly what happened. We saw a 5% decline over a day, the worst daily decline since 2013. And so what we're seeing here is this pullback. We've come past the 76.4 fib, but crucially haven't broken the 39.43. Now, key to that is the ability to break up through your first swing high. The first swing high comes here, which is 41.61. And if we rally up through that, that starts to give me confidence that maybe we have just seen a short-term pullback. I've sort of flushed out some of the heat in this market, and then the bulls come back into play. But look, the daily time frame, now that we've seen this long lower shadow on the Wednesday candle, if we see the bullish engulfing, and in particular we follow that up with a rally up through 41.61, it starts to tell a story of potential upside. But some of the data and the FOMC meeting should have something to say about that. If the data points towards inflation being under control, the Federal Reserve being willing to continue cutting rates at the beginning of next year, then that points towards further upside coming into play for gold. But if things start to turn hawkish, be it heavy, sort of high inflation rates and a very cautious tone in terms of easing from the Fed, then maybe we start to see the sort of jitters coming back into this market once again for gold. But certainly that's really the key market everyone's following at the moment, trying to gauge whether the party's back on or whether the party's over. It's time to turn the lights off, essentially. Next up, let's look at things from the perspective of the eurozone. And arguably, you could say the eurozone is probably the most boring of the lot when it comes to the decision from the ECB, but we've also got a huge amount of economic data coming out over the course of the week as well. So I thought worthwhile looking into this. So the eurozone, we've got Ifo business climate on Monday, GfK consumer confidence out of Germany on Tuesday, then we've got inflation from Spain, GDP from Germany, GDP from the eurozone, economic sentiment, unemployment rate, inflation from Germany, then we've got the ECB rate decision, then we've got inflation from the eurozone as a whole. Look, what more do you want? It's all happening within the space of a week. Inflation, GDP, ECB rate decision. Those are the key parts of it. So if we're looking here, ultimately the question mark here is, did the ECB need to do more? Because they've already done a huge amount. You've got the likes of the Bank of England, which is very much lagging, and the UK economy could definitely do with a rate cut or two. Whereas the eurozone, it's sort of like, they want to be accommodative, they want to help out, but if you just continue to drive rates so low that essentially you don't necessarily keep any sort of powder dry for those bad occasions where you actually need to step in for emergency measures, then you're not really doing your job as a central bank. 0% interest rates is not the norm. It shouldn't drop back down to that outside of a major crisis. So I can see why when you have that crisis and you drop it down to 0%, why it's quite difficult to raise it back up, because it feels like you're trying to push back against the economy and do it some damage. But now that we've seen it go as high as it has in terms of interest rates, the pullback doesn't necessarily need to come back to 0%. And that's what markets are really going to be keen to understand. How far do we go? Are we there? Have we done it? Have we seen all the easing we're going to get from the ECB? Inflation, by and large, is under control. You can see here in terms of the inflation rate for the eurozone year on year, expected to go from 2.2 to 2.1. The core figure 2.4 to 2.3. So we're around the twos. And then, in terms of the health of the economies, well, look, 1.1 expected on year for the eurozone. Pretty much non-existent for Germany. 0.1 expected for Germany. So, they are in a position where they could help if needed. It's just a question mark of how much they think that what they've done already pretty much should be good enough to help, certainly from a sort of differential standpoint. The eurozone has much lower interest rates than many of the other major central banks. Now, in terms of the inflation rate, we can see here that inflation on a monthly basis has been near enough non-existent over the course of the past, say, I think it's 6 months, 5 months. And then we've got major figures from February, March, April, that once we come back round to that in 2026, you're going to see the possibility of further disinflation coming into play. There's going to be some jitters over the near term, and you can see that here with the November figures negative, the January figures negative. So that could provide some upside surprises when it comes to the year-on-year inflation rate. But certainly, if you're looking at the 3-month annualized for headline and core, you can see that inflation really has been very low of late, tracking at a pace of roughly 1%. So it certainly isn't necessarily a concern as things stand. Now, in terms of the outlook for the ECB, you can see that the perception is that we don't get a cut, just a 2% chance of a rate cut. And if you look at the next cut, ultimately you're talking about the midway point of next year, at which point it's only a 50-50 split. So markets don't even know if there's going to be another rate cut or not from here on out. That gives us a sort of theme to focus on for the meeting. What is the lead from Christine Lagarde and co in terms of expectations for next year in particular? But we don't expect to see a rate cut this time. I don't expect to see a rate cut next time either. But certainly, what's the outlook going forward? That is going to be really key. In terms of the chart, I just wanted to jump onto the likes of euro dollar, and that's because if we're looking here, let me just try and make that a bit bigger for you. So euro dollar, there we go. There you go. Right. Sorry, euro sterling. This is one that I've been sort of pounding on about for a while now, and with the fact that we're seeing this weak inflation data out of the UK, I think it really sort of reiterates the point. So we can see from a wider perspective, the weekly time frame, this sort of regaining of ground. I think we've sort of bottomed out here and potentially pointed towards another sort of lift-off for euro sterling going forward. And the daily time frame, we can see that we had this sort of ascending trend line sort of move coming into play here, and then we've come back into it once again. Now, ultimately, this is all just a sort of drawn out retracement phase of that rally, right? So if we get the fib onto that and then we just drag that up, let's just see exactly where that's come into. So you can see it's already hit that 76.4 fib back here alongside trendline support. And now we're just mucking about basically as a precursor in my mind to then pushing up through the 0.875 mark. And certainly, if we see an ECB that essentially draws a line under easing and says, we've done everything we need to for the time being, yes, we'll act if needed in the future, but I don't think we need it at the moment. We've already done a lot. Then we see a sort of Bank of England, which is faced with inflation that appears to be relatively under control over the past 5 months. Then that points towards them being able to ramp up their sort of rhetoric around easing, and that points towards the upside move possibly coming for euro sterling. So for me, I remain bullish unless we break the swing low, which is 0.863. The tag of the 76.4 fib, the ascending trend line coming into play, all points towards the bulls coming back into focus. And so greater confidence of that comes with a breakup through this near-term zone of resistance. You can see at the moment we're just sort of ranging between sort of 0.866 and 0.872. At the moment we're ranging, that means a breakup through that level would be required for a rally up through the 0.875 and a move onwards. Until that happens, there is a chance we do respect resistance and pull back once again. But in my mind, that is just an opportunity for the bulls once again. So I do think, maybe it's been a bit slow in the making over the course of the past few weeks. But I do think that this retracement is exactly that. It's a retracement before the bulls come back into play once again for euro sterling. Now, let's look at, here we go, the final topic, and that is earnings. I mean, earnings season, of course, rumbles on, but crucially, this week has 5 of the Mag7 names reporting their latest earnings. So a massive week in terms of earnings. Quite frankly, this is what it's all about, right? I mean, essentially, the growth of the index at the moment really has been driven by the big tech names, because ultimately many other companies, if they underperform, then people think, oh, okay, fine, it's not the end of the world. But these companies, it's sort of like they have to just keep beating and beating and beating to continue this incessant rise that has driven the market higher. As you can see here, Microsoft, Apple, Google, Amazon, Meta, and then some other big names, Eli Lilly, sort of Visa, MasterCard. We've got the oil names with Chevron and ExxonMobil and the like. So a really interesting week in terms of earnings. This is one of the key themes that we're looking at here, which is the growth of earnings from the likes of the Mag7 names compared to the likes of the rest of the market, essentially. And in actual fact, what's notable here is the expectation is that we are going to see a pickup in terms of earnings growth within the beginning of next year. That's notable because for the past year, the prediction has been that we're going to see a slowdown in terms of earning growth from Mag7, but we're going to see a pickup for the rest of the market. So this sort of gears us up for the possibility of a really strong beginning to 2026, where Q1, Q2 sees both the Mag7 names and the remaining 493 names, so essentially the entire S&P 500, all growing the pace of their earnings per share. So if that happens, that's very bullish for markets. You can see here that at the moment, as things stand, firms have been beating estimates in terms of their earnings by the most amount in 4 years. Only marginally so, it is on the rise, but it shows that in actual fact, despite, I guess some of the headlines for things like Tesla, by and large, so far, earnings season has been a positive one. You look at the banks, they all smashed it pretty much. And then instead, we all end up talking about regional banks because a couple of banks been hit with bad loans, right? But, the big ones are the ones that mattered and they beat estimates. The caveat here is that generally these companies, it's in their interest to have estimates lower than what they're able to do, right? They almost want to guide it a little bit lower to be able to beat estimates. So some would say those estimates are made to be beaten. In terms of the charts, I just wanted to quickly blitz through the charts for those 5 Mag7 names to round things off and just see where they're sort of stacking up heading into the week. So we'll kick off with Microsoft. I've got all of these currently geared up on monthly timeframes just to give you an idea of where we are in the sort of bigger picture. So of course, the bigger picture is very impressive, but what we've seen here is that sort of rally higher, the pullback here in August, and now we're starting to regain ground. So there's a question mark, of course, whenever you're within a trend like this, as to whether you're in this kind of phase when you see a pullback or whether you're in something like this, right? So you always can see sort of one-off months or periods of like 1 or 2 months of downside, and then the bulls come back into play. We saw that pullback, and now we're starting to see it regain ground once again. As you can see here, that chart starting to regain ground, sideways consolidation, starting to push a little bit higher once again here. Let's just look at this on the daily time frame. So again, this is quite tentative. You can see it's probably a case of just holding out until earnings at the moment. That's going to be the real catalyst, because whilst we are creating these higher highs at the moment, the lows are pretty much flatlining. So a break below 505 would be a warning sign. If the earnings come out and we break the 531 mark, then really that starts to sort of gear things up for that next push back towards the record high levels around that sort of 555 level for Microsoft. In terms of Apple, here's your monthly time frame. So on this chart, is trying to break up through that prior high. We saw that big pullback with all those fears around tariffs and the breakdown in relations between the US and China, but things seemingly hunky-dory for the time being. So we're within this bullish phase, certainly a lot more sort of momentum over the near term compared to Microsoft. You see that pullback in a mid-size, that looks like a sort of 50% retracement to me, and then the rally up through that prior high. So pullback coming into play here, but unless we break that recent swing low, which currently holds here at 244, then it points towards this current pullback as being just a retracement, right? Just more of the same, right? Pullback, rally, pullback, rally, pullback, rally. So pullback, likely rally, unless the 244 breaks. Then we've got Google. I mean, this is incredible. We're just right in the middle of a big surge, having cleared out that prior high. You've seen this pullback over recent weeks, but now challenging that prior high. On this occasion, you're seeing sort of a flag formation, really. I mean, it's a longer time frame, but you're seeing this pullback coming into play here with essentially a descending channel. Then that rally up through the first swing high, which took hold here, signals that essentially we're done with this phase and that the bulls are back in charge, even if we see a retracement. So the retracement then gives you a potential buying opportunity as long as you don't break the swing low, which is 236. That didn't happen. And so I'm bullish for this market. As long as we don't break that 236 mark, I'm expecting more of the same, further upside here for Alphabet. And not finally, we've got 5 of them. I thought it was 4. Okay, we've got Amazon. So Amazon, again, we've got this big rally up. The latest rally appears to sort of fallen short of the prior high, now sort of fading a little bit. Are we looking at a topping pattern here, having failed to break the prior high? Or are we just consolidating and pausing before another push in towards that record high? You can see here 211, real key level here, because that would form a double top formation if we see a breakdown through that line. Let's just sort of extend it out there. So you can see here we've got this double top formation. At the moment, respected it perfectly. We're rallying higher, but there's still another challenge really, which is the ability to exit this near-term phase of lower highs. So lower high, lower high. Do we manage to break through the 228? If we do, then it gives you greater confidence that we're not going to form that double top formation and the bulls are going to continue apace. But certainly I'd say there's some question marks coming into earnings here for Amazon. And finally, for Meta, the monthly time frame shows you again an incredible chart here. We've seen a bit of a pullback of late, set within this phase where we saw that big surge following that initial sort of election Donald Trump jitters. Well, the bulls are back in charge. They've rallied. We've seen this pullback recently. You know, do we see these long upper shadows as being indicative of a wider pullback coming into play here? Well, the daily time frame looks like this. We can see that essentially we have recently broken through that trend support here, because we've now created a lower low and then come into this zone of support here. Now, crucially on the top end, we also didn't see a higher high. So you've got this pattern where we were essentially rallying, higher low. Then we see a failure to create the new high, a new lower low. That is a potential warning signal, in particular if we break the 691. Now we're regaining ground at the moment, but really I'd need to see a break up through this swing high here, 790, to give me greater confidence that this isn't just another lower high before we roll over. So really a breakthrough 691 or 790 should give us guidance on this one. But as things stand, you can see over the near term with this double bottom formation in play following the breakup through 735, it does point towards near term pre-earnings upside in play for Meta, if only to come into that sort of deep retracement zone between just sort of 770 and 760. But ultimately the exit from 691 and 791 will tell us a lot more about whether we're going to break higher or whether we're going to see a more protracted pullback here for Meta. I hope that's been useful. It's a bit more of a longer recording this time around, plenty of charts to cover, but make sure to like, subscribe, follow. Plenty more content like this from myself and the Scope Markets team. My name's Josh Mahoney, Chief Market Analyst. Have a great day and a great week ahead.